What I'm about to share with you, I honestly believe to the bottom of my heart. And I'm going to take a lot of heat for this in the comments. So my only motivation for sharing this is I want to see you succeed. So here goes. Been a financial advisor for 20 years. And one of my key takeaways is that the average investor could have 10% more, 25% more, 50% more in their retirement savings if they had used a professional for the journey as opposed to doing it themselves. And I know I'm biased. Again, I'm a financial advisor, but hear me out. Let me share with you why I feel this way. This is a result of a 20-year journey. Take 7 or 8 minutes, watch this video, and let me know in the comments if you think I'm crazy or what you think, but please be kind. Okay, there's a series of studies called the Dalbar studies. And this is a third-party think tank that looks at how the average investor does investing in their 401k. So they have relationships with the major custodians of the world where 401ks are held. And they can actually analyze this data and give employers and the financial industry information. How is the average investor doing and how can we help them? And that's the spirit that I share this with you. I'm not saying you should use me. I just want you to know this and you make your own decision. Okay, let's jump in. Dalbar calls what I'm about to share with you the investor behavioral penalty. And they call it that because they say that it's our emotions that are causing us to see the behavior, to see the results you're about to see. Okay, so this is the returns of various asset classes. Let me start at the left and work my way to the right. So this is over a 20-year period from 2001 to 2020. You can see of the asset classes that they looked at, the number one performing was gold. It was up 10% a year. That's a big move, right? REITs are real estate, the RE is real estate, investment trust. So think commercial real estate. That was up almost 10% a year, 9.5%. The S&P 500, this is a solid return, 7.5% per year during this period. International stocks were only up 5% during this period. Bonds, the total return, including the interest on it, were up 4.8%. Our personal homes up till 2020, there was a big bump after that, but up till 2020 was up 3.7%. So how did the average investor do? The average investor did 2.9% a year, choosing from largely these asset classes that we see in the left. And inflation was up 2.1%. So the average investor barely beat inflation. They did not beat inflation by 1 percentage point. They barely beat inflation. Now, how do you look at those asset classes and end up doing, let's call it 3%? How do you look at asset classes that are all doing 3.7% or better and end up with 3%? Well, first, to the furthest one to the right is how oil did during that period of time. You can see that negative. But I don't think the reason these people underperformed was because they went long oil. I don't think that's what caused it. I think what happened and what Dalbar would say is, unfortunately, we as humans are wired to chase things that are attractive, go for that juicy apple in the tree. And we've evolved to run away from scary things. The lion in the jungle, we want to stay far away. And that was great for, the period of time that we were evolving, that we had to worry about those things. But these human tendencies are no longer helping us. And in fact, I think they're hurting us dramatically. And that's what Dalbar would say the reason for this underperformance. So let's see what this means. So if you go to this chart here, you can see the first period of time is 1992 to 2021. This is a 30-year study. And during that period of time, inflation was 2.3%. And the average equity investor did 7%. And the average, the S&P 500 did a little better than 10.5%. But what does that mean if you had started that period with $100,000? If you had started that period with $100,000, over the next 30 years, your $100,000 would have doubled. Your money, the average investor would have done almost 8 times. They would have gotten 8 times return, which is good. But look at what the S&P did, almost 2.1%. Now, I want to say that I do realize that the period that you pick, right? Statistics tell you more about the statistician. I'm not a statistician, but if you choose your time period, you can get the results that you want. So let's look at another time period. This next study is a 30-year study, different time period. So instead of 92 to 2021, this goes 93 to 2022. And what do we see? What we see here is inflation was about 2.5%. The 2.74%, this is essentially what the risk-free rate of return is. So this is debt from the US government that was going to mature in a year. So unless the US government goes bankrupt in the next 12 months, you're going to get your money back. So that's as close to a risk-free return as you're going to get. And so during that period of time, it just beat inflation. The average equity investor did 6.8%, and the S&P 500 during this period did 9.65. So again, the same question: what is the growth of $100,000 over 30 years? Inflation would take you to a little over $200,000. The risk-free rate would have given you a little bit more, about $15,000 more, about $225,000. The average equity investor would have gotten almost $751,000, $721,000. But look at the S&P 500. The S&P 500 was almost $1.6 million. So in that first example I gave you, the $789,000 to almost $2.1 million, people left over $1 million on the table. If you look at the second year, you'd have over double, the second time period, I should say, from $721,000 to $1.6 million. So, what does this tell us? Again, Dalbar is an independent organization. I like it because I think it tells an important message, and it's what I see. Oftentimes when people call me on the phone, they'll tell me about all of their great stock picks. And, sometimes as the money that you're managing, as you're getting closer to retirement, when you have $100,000, if you make a 10% mistake because you're managing it yourself, you lost $10,000. Is that going to change your life? Probably not. But when you have $1 million, if you make a 10% mistake, that's $100,000. That's real money. And let's just say that your financial advisor charges 1% a year. If you make one 10% mistake, you could have had a professional by your side along during that journey, doing not just helping you with your investments, but everything that's related to your financial point of life. So, unfortunately, a lot of us are going to make a 10% mistake. Candidly, I've shared with you in my personal account, I've made 10% mistakes in the past, right? I'm human as well. Now, professionally, when you're managing money, you bring a different level of discipline to that when you're managing other people's money than maybe when you're managing your own money. So are financial advisors immune to this? No, we're not, right? But we have the knowledge, and we've been doing this long enough. This is what we've done in our profession. Now, again, I'm not saying, hey, reach out to Azul and ask me if I can work with you. I'm not saying that at all. I'm asking you to consider your situation and whether you would benefit from having somebody by your side that's removed, one step removed from your account. What Dalbar would say this investor behavior penalty is again, it's that fear and that greed. The greed is going after the juicy apple. The market, as I record this, the market's at all-time highs, right? And so it feels really low risk. Hey, week after week, month after month, the market's going up. It feels low risk. And unfortunately, that lures people in, right? It feels lower risk than what it really is. And there's different measures that you can look at to see what the average person thinks the risk in the market is. There's some called the VIX, which is the price that people are paying on options. I'm getting deep in the weeds, but there's different measures that are determined by the marketplace that can give us a feel for what the average person feels, how risky the market is. And ironically, people feel the market's the least risky. Most people, I'm not saying you, but most people feel the market's least risky when it's at a high. And actually that's when it's at, that's when you're at the most risk of a correction because the prices are higher. And then when prices are low, a lot of people don't want to buy because they're like, wow, look at that. The stock market has dropped 30% over the last 12 months. I want nothing to do with that. Or even worse, you're in the market and you're saying, this is causing me pain. This is not only causing me to worry, this is causing me anxiety. And anxiety is a level of worrying to the next degree, right? It's acute worrying where it keeps your sleep. And people are making decisions and saying, I just want the pain to stop. And that's a natural human emotion. So how do you protect yourself from that? I'd encourage you to think about working with a fee-only financial advisor. Why fee only? Because they're going to have a duty to you, a fiduciary duty to you 100% of the time. Second, let's say the market were to start a correction tomorrow. I don't have a crystal ball. I don't know. If that were to happen and the market drops 10, 20% in a short period of time, what you do to protect yourself from that, unfortunately, are the things that you did 2 years ago, 4 years ago, 6 years ago. And the primary tool you have for that is your asset allocation. What percent of your portfolios in stocks and what percent of your portfolios in bonds? So, a lot of retirees, this is not a recommendation. I don't know your situation, but a lot of retirees might be 60% in the stock market, 40% in the bond market. And the idea is the bonds are going to hold up. But I don't want you to think about your asset allocation as 60-40. I want you to think about your asset allocation as how many years worth of living expenses do I have in safe, stable, secure bonds. And by that, I mean really strong companies that have a strong balance sheet and bonds that are going to come due in 6 months, 12 months, 18 months, 24 months, maybe going out 3, 4 at the backside, 5 years. High quality bonds. So maybe one of the United States' largest retailers. I don't like to mention specific names here, but is the U.S.'s largest retailer going to be able to pay off its bonds in 18 months? I think so. Are they going to be around in 20 years? I don't know. The world changes very quickly. But are they going to be able to pay off a bond in 6 months? I feel comfortable with that. You have to decide that yourself. But the important thing here is something that's going to be very strong level of security and price stability. So if the market does go down, you don't become what I call a forced seller of stocks in a down market. That's how the people in this Dalbar study got hurt, is they were switching in and out. They were chasing things that were working and they were staying away from things that were out of favor and maybe had gone down. So the full Dalbar study, you can buy that. It's like $1,500 to buy the study, but that's the essence of the report. Is we're wired as human beings to hurt ourselves as investors. So you make the decision, you vote in the comments. That's my case. I honestly feel, and my only motivation here, you do what's right for you. But I want you to know about this. I want it on your radar screen so you can do more research. And I can tell you, I've talked to thousands of people about their investment journey. And oftentimes people will say, oh, I've made this great investment or that great investment, which is all true. But when you look at the totality of what they've done over a decade, what I see agrees with the Dalbar study, that most people are dramatically underperforming what they could be doing if they had a professional by their side, helping them make good decisions along the way. How should you pick your financial advisor? Everybody wants to find the next Warren Buffett, but somebody that's going to outperform the market. But even Warren Buffett isn't always Warren Buffett. There are long periods of underperformance at Berkshire Hathaway, which Warren Buffett runs, has had in the past. So how do I think you should pick your financial advisor? The group that's going to help you make the best decisions, financial decisions, along the journey. The group that's going to help you handle the complexity that comes with managing your money. You want to give that to somebody else, right? I'll let you know in on a secret. If you've watched this long, you deserve to hear this secret. And I've never shared this on YouTube before. You ready? When I retire, I'm not looking at my accounts. I'm not managing my money anymore. I am going to use a professional to manage my money. This is what I've done for my life. When my time comes to hang up my cleats, I'm letting somebody else worry about this. So not only do I feel this way as a professional that's been in the industry for over 20 years, that helped guide hundreds of people into retirement, but I'm following the strategy that I want you to think about doing. So that's how strongly I believe in it. So if you want, leave me a comment. Let me know what you're thinking. If you disagree with me, absolutely fine. I love when people disagree with me. The only request I have is please be kind in how you share your point. If you agree with me, let me know that too. I also want you to think about watching this video up here, which I think is, if I had to pick 5 topics, today's video would have been one topic, and this video up here would be another topic, which are 8 things that I want you to stop doing in your 60s, in your 50s, as you're approaching retirement, to enjoy the journey. It's not just about getting to that starting line of retirement. It's about enjoying the journey. And that's what this video is here. Thanks for watching this one, and I'll see you in that video. Bye-bye.